Welcome to our deep dive into strategic profit management. In today's competitive business world, organizations must adopt effective strategies to survive and thrive. This video will guide you through the essential concepts of profitability analysis, activity-based costing, and advanced cost management techniques. We'll explore how companies can measure, analyze, and improve their profitability by focusing on the right activity and making informed decisions. Whether you're a student, a finance professional, profitability analysis is more than just looking at the bottom line. It helps organizations measure their performance against industry standards and internal targets. By analyzing profitability, management can identify critical success factors, spot trends, and make decisions that drive sustainable growth. This process involves examining revenues, costs, and the factors that influence them. With the right tool, businesses can pinpoint areas of strength and weakness, ensuring resources are allocated. Michael Porter's generic strategy theory is a cornerstone of strategic profit management. According to Porter, a firm can achieve long-term profitability by choosing a strategy that fits its environment and aligns with its corporate objectives. The two main approaches are cost leadership, producing at a lower cost than competitors, and differentiation, offering unique features that set products apart. Whichever path is chosen, performance measurement is essential to track progress and correct deviation. Strategic profitability analysis breaks down operating profit into three main components: growth, price recovery, and productivity. Each component reveals different drivers behind changes in profit. The growth component measures how changes in sales volume affect revenue and cost. Price recovery looks at the impact of price changes on both revenue and cost. Productivity examines how efficiently resources are used, focusing on improvements in input mix and yield by annum. Growth component measures the effect of changes in the quantity of output sold. When a company sells more units than the previous period, both revenue and costs are affected. The revenue effect of growth is calculated by multiplying the increase in units sold by the previous year's selling price. On the cost side, both variable and fixed costs are considered, using formulas that account for changes in input requirement and capacity. This analysis helps management understand. Price recovery component isolates the impact of price changes on operating income. This involves analyzing how changes in selling prices and input costs affect revenue and expenses. For example, if a company raises its selling price, the revenue effect is calculated based on the difference between current and previous prices, multiplied by the number of units sold. Similarly, changes in input prices affect costs. By separating these effects, management can see how productivity measures how efficiently a company uses its resources compared to the previous period. This component focuses on changes in the product mix and input yield, using current year prices to assess cost changes. Improvements in productivity can lead to lower costs and higher profit, even if sales volume or prices remain unchanged. By analyzing productivity separately, organizations can identify operational efficiency and areas for process improvement, driving long. Reconciling operating profit involves bringing together the effects of growth, price recovery, and productivity to explain changes from one period to the next. By systematically adding or subtracting the revenue and cost effects of each component, management can clearly see what drove the profit change. This structured approach ensures that all factors are considered and helps in pinpointing areas that need attention or improvement. It also supports transparent reporting and informed decision-making. Let's look at a practical example. While Limited, a manufacturer of cardboard boxes, analyzed its operating income between 2023 and 2024. The company broke down the change in profit into effects from market size growth, productivity improvement, and product differentiation. By calculating the contribution of each factor, management could see exactly how much each influenced the bottom line. This kind of detailed analysis helps companies understand. Activity-based costing, or ABC, is a powerful methodology for assigning costs to products, services, or customers based on the activities that drive those costs. Unlike traditional costing, which often uses broad averages, ABC traces costs more accurately by focusing on resource consumption. This approach is especially useful in environments where overheads are significant and not directly tied to production volume. ABC provides management with better information. Direct product profitability, or DPP, is an analytical method used primarily in retail to measure the true profitability of individual products. DPP attributes both direct and indirect costs, such as warehousing, transportation, and store costs, to each product line. This allows management to see net profit, not just gross margin, for each product. By understanding which products are truly profitable, companies can make better decisions about pricing. DPP analysis offers several key benefits. It enables better cost analysis by revealing the true profitability of each product. This supports more informed pricing decisions and helps optimize the use of store and warehouse space. DPP also encourages the rationalization of product ranges, allowing companies to focus on high-performing items and eliminate or reposition low-profit products. Ultimately, DPP provides a clearer picture of where profits are generated. Typical DPP statement starts with sales revenue, subtracts the cost of goods sold to arrive at gross margin, and then deducts direct product costs such as warehousing, transportation, and store expenses. The result is the direct product profit per unit. This detailed breakdown helps management understand the full cost structure and profitability of each product, going beyond the limitations of gross margin analysis. Consider a practical example comparing products like ice cream, baby food, toothpaste, wine, and paper tissue. DPP analysis reveals that products with high storage or handling costs, such as ice cream, may have a much lower net profit than their gross margin suggests. Conversely, products that occupy less space or require less handling can be more profitable. This insight helps retailers make smarter decisions about product placement, inventory, and promotion. As DPP per unit is useful, analyzing DPP per unit of time or per measure of space adds valuable dimension. For example, a product that sells slowly but occupies a lot of shelf space may be less profitable than a fast-moving item. By factoring in time and space, retailers can optimize inventory turnover and maximize profit per square meter. This approach supports more effective merchandising and store layout decisions. Let's look at Jigyasa India Limited, which operates retail stores selling products like butter jelly, fruits and nuts, and icy cool. By calculating warehouse, store, and transportation costs per cubic meter, and then allocating these costs to each product based on volume and time in storage, the company determines the true profit per unit. This detailed analysis highlights the importance of accurate cost attribution and helps management focus on the most profitable product. Customer profitability analysis is just as important as product analysis. Different customers use different amounts of company resources, leading to variations in profitability. By analyzing customer-specific activity, such as order processing, delivery, and after-sales service, companies can identify which customers contribute most to profit and which may be eroding it. This insight supports better customer management and targeted strategy to improve overall profitability. EPA helps suppliers identify which customers are most and least profitable. It provides a basis for constructive dialogue with buyers, enabling both parties to improve margin. By understanding the true cost to serve each customer, companies can tailor pricing, service levels, and promotional efforts. This leads to stronger relationships with profitable customers and more effective management of less profitable ones. Consider XYZ Electronics Limited, which sells audio players to two customers, A and B. By analyzing sales volume, discounts, delivery, and order processing costs, the company discovers that customer A, despite lower sales volume, is far more profitable than customer B. This is due to differences in discount policy and service requirements. Such analysis helps companies refine their discount strategy and focus on the most valuable customers. Advanced manufacturing environment, overheads often make up a large share of total cost. Activity-based costing provides more accurate product costing by tracing overheads to the activities that drive them. This is especially important as automation and technology shift cost structures from direct labor to indirect equipment and support costs. ABC enables better cost behavior assessment, continuous improvement, and more informed decision-making. The rise of automation, traditional labor costs are being replaced by equipment and support overheads. ABC is particularly useful in this context as it accounts for non-unit level overheads like setup, inspection, and material handling. By linking these costs to appropriate drivers, ABC provides a more realistic picture of product costs, supporting better pricing and investment decisions. Activity-based management, or ABM, extends ABC by focusing on managing activity to improve value for customers and profitability for the company. ABM uses cost information from ABC to analyze cost drivers, eliminate non-value-added activity, and measure performance. This discipline supports continuous improvement and strategic decision-making, helping organizations do the right thing and do things right. First step in ABM is cost driver analysis, identifying the factors that cause costs to change. For example, the quality of parts received can influence the resources needed for production. By understanding cost drivers, organizations can target improvement where they will have the greatest impact, leading to more effective cost management and higher profitability. Activity analysis is central to ABM. It involves classifying activities as value-added or non-value-added. Value-added activities are essential to delivering products or services customers are willing to pay for. Non-value-added activity, on the other hand, create waste, add costs, or cause delays without enhancing value. By identifying and eliminating non-value-added activity, organizations can streamline operations and reduce costs. Performance analysis focuses on measuring how well activities are performed. This can be done by comparing actual activity rates to industry benchmarks or by analyzing time spent on key activity. Performance reports highlight areas with the most potential for improvement, guiding managers to focus their efforts where they will have the greatest impact on efficiency and profitability. Value-added activities are those that are indispensable for completing a process and for which customers are willing to pay. For example, polishing furniture in a manufacturing process adds value because it enhances the product's appeal. Identifying value-added activity helps organizations focus resources on what truly matters to customers and supports competitive advantage. Non-value-added activities do not improve the quality or function of a product or service and are not valued by customers. Examples include unnecessary movement, waiting, storing, scheduling, and inspecting. These activities create waste and add cost without contributing to customer satisfaction. Identifying and minimizing non-value-added activity is key to improving efficiency and reducing costs. Most operation, time is spent in various ways: receipt time, process time, queue time, move time, and inspection time. Only process time is value-added. The rest are typically non-value-added. By measuring and analyzing these time components, companies can identify bottlenecks and opportunity to streamline processes, ultimately improving customer response and reducing costs. Manufacturing cycle efficiency, or MACI, is the ratio of value-added time to total manufacturing cycle time. A perfect MCE is 8, meaning all time is value-added, but in reality, most companies have much lower ratios. By striving to increase MCE, organizations can reduce non-value-added activity, speed up production, and lower costs, delivering greater value to customers. Consider a doctor's office visit where only 30% of the time is spent with the doctor, and the rest is waiting or filling out forms. By minimizing non-value-added time, the office can treat more patients and improve satisfaction. Similarly, in manufacturing, reducing waiting, moving, and inspection time increases MCE and overall productivity. ABM is used for a variety of business applications, including cost reduction, activity-based budgeting, business process, re-engineering, benchmarking, and performance measurement. Each application leverages activity-based insights to streamline operations, improve quality, reduce costs, and foster innovation. By focusing on activity, organizations can better satisfy customer needs while using fewer resources. Activity-based budgeting, or AB, is a planning and control system that estimates the resources required for each activity based on forecasted workload and strategic goals. ABB starts with identifying the type, quantity, and cost of work to be done. By focusing on activities rather than departments, ABB supports continuous improvement and more accurate financial planning. Like traditional budgeting, which allocates costs by department or function, ABB builds budgets based on the activities required to produce products or services. This approach provides greater visibility into cost drivers and supports more effective resource allocation. ABB also enables flexible budgeting, allowing managers to adjust plans as activity levels change. The example of Chetwell, an international convenience store chain. By using ABB, the company budgets costs for ordering, delivery, shelf stocking, and customer support based on activity drivers. This approach helps managers better identify resource needs, link costs to responsibility, and spot budgetary slack. ABB supports continuous improvement by highlighting areas for cost reduction and process optimization. Kaizen budgeting is a continuous improvement approach that sets monthly cost reduction targets. By comparing actual costs to these targets, managers are encouraged to find creative ways to reduce expenses. While Kaizen budgeting promotes ongoing improvement, it may overlook irregular cost fluctuation, so companies should balance incremental and breakthrough improvement. ABC is invaluable for management decisions, from product line analysis to facility expansion and human resource planning. By tracing costs to activity, ABC reveals the true cost structure and supports decisions about pricing, outsourcing, and process improvement. Companies can use ABC to track the financial impact of quality initiatives and optimize their product and customer portfolio. Leading beverage company in Belgium used ABC to analyze its cost to serve, CTS, and streamline its distribution processes. By implementing ABC, the company gained detailed insight into cost, enabling fair internal charging and process optimization. The result was improved efficiency, reduced cost, and alignment with corporate strategy, demonstrating the real-world value of ABC. Pareto analysis, or the 80/20 rule, states that 80% of results come from 20% of causes. In business, this means a small number of products, customers, or issues often account for the majority of profit, cost, or problem. By focusing on the vital few rather than the trivial many, organizations can achieve significant improvements with targeted effort. Pareto analysis is widely used in inventory control, quality management, customer profitability, and cost management. For example, 20% of products may generate 80% of profits, or 20% of defects may cause 80% of quality issues. By identifying and addressing these key areas, companies can maximize returns on their improvement efforts. Pareto chart visually ranks causes or issues in descending order of significance. For example, in a spectacle manufacturing company, most defects may be due to a few key problems like scratches or rough edges. By constructing a Pareto chart, management can quickly identify which issues to tackle first for the greatest impact. Pareto analysis helps break down big problems, prioritize efforts, and ensure optimal use of resources. However, it relies on accurate data and may overlook small issues that could grow over time. It's important to apply Pareto analysis thoughtfully and review results periodically to ensure ongoing effectiveness. Pricing Pareto analysis helps companies focus sophisticated pricing methods on the most important products while delegating simpler decisions for less significant items. Similarly, analyzing customer profitability often reveals that a small percentage of customers generate most of the profit. This insight guides marketing, sales, and service strategy for maximum impact. Pareto analysis is also valuable in stock control and quality management. For inventory, a small number of items may account for most of the value, so focusing on these items improves control. In quality, addressing the few causes responsible for most defects leads to significant improvement. Regular reviews ensure that new issues are identified and addressed promptly. Recap: strategic profit management involves analyzing profitability through growth, price recovery, and productivity components. Activity-based costing and management provide accurate cost information for better decision-making. Direct product profitability and customer profitability analysis reveal where profits are truly generated. Activity-based budgeting supports efficient planning, while Pareto analysis helps focus efforts on the most impactful areas. Together, these tools. Thank you for joining us on this comprehensive journey through strategic profit management. By applying the concepts and tools discussed, organizations can unlock new levels of efficiency, profitability, and customer value. Whether you're implementing ABC, optimizing your product mix, or using Pareto analysis to prioritize improvement, the key is to stay focused on data-driven decision-making. Continue exploring these topics, and you'll be well equipped to drive your organization.